BlackBull markets. Behind me, the chart of the US 30, the Dow Jones, the largest 30 companies capitalized in an ETF, which ticked 652 points lower today, following an inflation reading at the highest level since 2008. That was way above the 3.2% expectations and came out at 4.2 CPI. It's high since 2008, and we all know what happened in 2008. And as investors' fears of more inflation set to come, we are seeing vulnerability in the stock indexes, which of course are trading at those all-time highs. However, as we know from the monumental trend over the last 12 months, buy the dip is well in play, and I'm going to look at the daily time frame to show you where this dip could possibly be, or potential case for a free fall to the downside if certain factors do play out. So let's have a look at the daily time frame. As we can see on the daily time frame, the US 30 is currently testing that key 20-day moving average, which since late last year, well, November last year, marked on this chart, of course, it's been not using to find bounce back points, as we saw here in earlier on in February, as well as that March low. So we have seen a consistent theme of coming down to that 20-day moving average, buyers finding another aptitude to potentially look at taking the market higher. However, what we have seen in recent weeks is a congestion zone in the US 30 around the 34,000 mark, where we haven't really triggered higher. Of course, we had one rejection of the 35k mark, but as we do know, fundamentally nothing has really changed. Interest rates are still at rock bottom, stimulus is still free flowing, and that money is basically being diverted all the way into these equity markets. So this could be a prime opportunity for a buy here. Even better, a move below that, and if you are still very bullish, you're looking at 33k. Anything up from 32.5 to 33k, essentially this area here as a buy interest levels. But however, if we look on the other side, we're really looking at a significant fall to put this into bear territory. And when I say bear territory, I'm looking at about 6 or 7 consecutive negative trading days. We've had these two daily candles, which are pretty significant. Now, a fall below 32.5 could really start to mark interesting territory for bears to start to take this market lower, back into those previous moving average support areas that we saw earlier on in March and January, and that's around the 31.5, 30k mark. So that's what I'm really looking for on both sides of the story with the US 30. It could be a great indication as to the future of the US economy, as well as a depiction of investor fears. If that does continue, we could see more movement to the downside, but saying that buy the dip mentality is certainly on, so definitely look out for opportunities, use a stop loss and trade safe.